Well, this is the FarmDoc Daily Live Coronavirus and Ag Webinar Series. I'm University of Illinois Extension's Todd Gleason. Our panelists for the day include Nick Paulson from the FarmDoc Daily team here at the University of Illinois, Ag Economist, and Joe Glauber with IFPRI, that's the International Food Policy Research Institute. He's in the Washington, D.C. area. We'll be taking your questions, of course, and talking about ag trade today. Nick Paulson is now with us. Hey, Nick, thank you so much for taking time to be here today. Why don't you go ahead and take us through your slide set, please?
Sure. We're actually going to start off before I even get into my slides with a poll question. This was actually a suggested poll question that was submitted by one of our regular participants. I won't point them out by name specifically, but it's just something that was submitted yesterday. So if production or other supply chain issues related to COVID-19 create potential domestic shortages, should the government intervene to limit meat exports in some way? We've got 4 options there. Yes, exports should be stopped. Yes, exports should be limited partially or in some way. No, exports should continue. Or the 4th option, as always, is I don't know. We've got about close to half of our attendees so far have voted, over half now. Get those results up here in a second. 60% have now voted. All right, we'll get those responses collected here, close the poll. And our poll results, we've got a very small percentage of people saying exports should be stopped, about 1/3 limited in some way. Almost 60% say no, export should continue, and 10% say I don't know. So those are some interesting responses. We can maybe talk about those as we go through there, or think about that as we start presenting some of the material this morning. So again, I want to leave as much time as possible for Joe Glauber to talk. Joe, he probably won't give himself as much credit or notoriety as he should when he introduces himself. So in addition to currently being a fellow at the International Food Policy Research Institute in DC, I want to make sure people know and recognize that Joe was a former chief economist for USDA, and then played a part as an envoy in the Doha trade negotiations. So thanks, Joe, for being here. It's great to have you
thanks.
Today with us. So again, just to kind of tee things up, I want to start from a broader perspective, and we'll kind of narrow down into issues related to phase 1 in China before I hand it off to Joe. But just wanted to start off with a bigger picture look and remind everyone about the relative importance of exports for some of the major ag commodities. And it's not surprising or new information for anyone that exports are a big portion of demand here, trying to capture that with the export shares of U.S. production for the 2017-18 marketing year using USDA data. You can see close to 80% of the cotton is produced each year is exported, ranging on down to as little as 10 or 11% for soybean oil and beef. Half of our soybeans, over half of our sorghum and wheat, and about 17% of our corn is exported. So while the relative magnitudes here exports are a very important component of demand for all of these commodities. The next few slides I'll take you through real quickly for some of the major row crops, and then I'll talk a bit about livestock as well. What I'm trying to illustrate here is just some of the U.S. competitors on the world export stage. So if we look at corn, kind of the top 5 players here, U.S. being the biggest, followed by Brazil, Argentina, Ukraine, to a smaller extent Russia, and everybody else lumped together there in the rest of the world. Probably the biggest message here on corn, and part of this is because of the smaller crop in 2019, but the loss of export market share, global export market share relative to 2017, compared with the next big 3 exporters, Ukraine, Argentina, and Brazil, who all gained market share over that 2-year time period. Soybeans, kind of the U.S. and Brazil are the major players. And then some role there for Argentina, Paraguay, and Canada. again, losing market share relative to Brazil over the last couple of years. If we take a look at wheat, there's a larger group of relatively large players on the global export stage. A handful of countries that are relatively similar in terms of market share, compared with the US, Russia leading, followed by the EU, and then the US. And still a large number of countries captured in that rest of world category here. So a little bit more diversity, less concentration in world wheat exports. And then the last row crop, cotton, in the US is the dominant biggest exporter in the world, biggest single country exporter in the world, followed by Brazil and India, and then a big group of rest of world countries comprising a big share of world wheat exports. Again, one of the major themes here is, especially for corn and soybeans, to a lesser extent cotton, and then not so much for wheat, we see a loss in world export market share for the US over the last couple of years. Didn't create these charts for some of the livestock categories, although I would say it's kind of a similar picture. On the beef side of things, we've got basically four main players, the US being one of them, along with Australia, Brazil, and India. The four of them accounting for about 2/3 of total world exports. For swine, pork exports, four countries comprise over 90%. That includes the US, Brazil, Canada, and the European Union. And then for poultry exports, the top four capture about 80% of the world export market share. The US and Brazil being the biggest, followed by the EU and Thailand. So US is obviously a major player in all these markets, but there is differing extents of export market competition from other major players. Again, taking a big picture look at US ag trade, and I'm actually including both ag and ag-related product exports here as reported by the Foreign Ag Service. We can see a pretty big increase in exports relative to 20 years ago, from about $60 billion to nearly $170 billion at the peak in 2014. Over that same time period, we saw China's market share of US exports, or the portion of US exports, ag exports headed to China, exceeding 20%, kind of stable at that 20% of total from 2012 to 2016, and then decline in the last few years with some of the trade policy and retaliatory effects going on here with the decline in the share going to China. Relative stability in total US ag exports to all trading partners. Kind of trying to segue a bit into the discussion of China and the Phase 1 agreement. Joe's going to talk about how the increases that China is committed to are measured relative to some 2017 baseline. Exactly what that baseline is not entirely clear, calendar years versus marketing years. But an increase of nearly $20 billion expected or committed to for 2020, $24 billion in an increase for 2021. 2017 baseline is about $20 billion for ag, $24 billion if you include ag and ag-related products. The increased commitments from China, sorry about that, are $12.5 billion in 2020 in additional to that baseline, and nearly $20 billion in additional for 2021. So just the sheer scale of those commitments represents a challenge in terms of how large they are relative to those 2017 baseline dollars. There's also some challenges or concerns facing the likelihood of meeting those commitments related to some of the current market conditions we're under, including COVID-19 and the strong dollar that's currently making U.S. Arguably less competitive on the world stage in terms of the price of our exports compared to competitors. So some headwinds there in terms of being able to meet some of those Phase 1 commitments. The next two slides, I've kind of stolen this from something that Todd Hubbs did early on when the Phase 1 deal came out. So what will China buy? How will those increased commitments be satisfied? Well, we can take a look at what China currently does buy, and we're all probably very familiar with the fact that soybeans kind of dominate the ag products that go from the US to China. They comprise little over half of what was exported to China in 2017 in terms of U.S. ag exports. But you can see some of the other top 10 product categories there: pork, dairy, wheat, cotton, all falling into the top 10. And then in the next slide here, I've got some of the other more kind of bulk ag commodity categories and related direct ag commodity categories highlighted here, including corn, ethanol, distillers grains, poultry, beef, and then soybean oil. And that's actually the reason I went next 21 instead of next 20, is soybean oil actually happens to be ranked, I guess, 31st here overall, at least in some of the 2017 numbers. So, the message from these two slides again is soybeans are one area where we could expect some big increases, just given the sheer magnitude of ag exports to China that they represent, but a pretty diverse collection of commodities once we get beyond soybeans that have significant trade values associated with them that we could see. Not all of them necessarily direct ag commodities, but others that are products that are from further along the supply chain. So with that,
Joe Glauber is with us. He's with IFPRI, the International Food Policy Research Institute, where he serves as a senior research fellow. Joe, thank you so much for being with us. Take us through your slides and maybe just a little bit about yourself and the work you're doing there at IFPRI, please.
Yeah, sure. And thanks very much. It's really nice to be on the program. I have been listening to some of these webinars and have gotten a lot out of them. So I hope I can pay back some of that. I think, as you said in the introduction, I've been at the International Food Policy Research Institute as a senior fellow there for about 5 years. And prior to that, obviously, or as many people know, I was at USDA for about 30 years. And most of that time in the chief economist's office, either as deputy chief economist or chief economist, and did do a little bit I actually over my career did a lot of trade negotiations. Worked on NAFTA, worked on the Uruguay round, and then I actually was chief ag negotiator during the Doha round in the last couple of years from 2007 to 2008. So have spent a lot of time doing trade over my time, and I still do that at IFPRI. Actually, still work a lot on farm policy, still work a lot on trade policy. But then do a lot of work on food security as well. IFPRI is part of a bigger group that works with the USDA and USDA's counterparts in other countries and trying to improve market forecasts and things like that. So anytime there are food shortages or weather problems, a number of us from various countries, including USDA, get together on a monthly basis. We just got off a call today talking about what's going on in the market. So which is great, because that was frankly the time I spent in the office of the chief economist. Probably the stuff I enjoyed the most was working on the market stuff. So enough about me. I guess I can jump into the presentation. So what I'm going to cover today is talk a lot about phase one, and then obviously, you think back over the last couple of years, what a wild couple of years. We, started with this trade war, and about the same time, we were hearing about the African swine fever and other things. And so all this concern over, if indeed we got a settlement in the trade war, what would the market look like in China because of all the problems their hog population was having. And then, from about January on, the concerns over COVID-19, particularly at first with China, but then obviously as it came here and seen all these major disruptions over the last, I'd say 2 months in particular, it's been a lot to sort through. So let me jump into it then with China. Move to the next slide. Yeah, so this is just a chart showing the overall U.S. agricultural trade. We hit a peak in 2014 with hitting about $152 billion. A lot of that, obviously, remember at the time we had really high prices coming off the drought in 2012-13, still very, very high prices for most agricultural or most of the row crops in any event. And as those prices started coming down, our trade volumes actually stayed very, very high. But you can see that since that time, we've been more in the $140 billion range. And that's, of course, what our current forecasts are. We'll see how they may change over time because, as most people know, prices for a lot of the commodities have dropped a lot since those forecasts were made in February by USDA. But again, the thing that is striking is that volumes have actually, if you were to look at individual commodities, yeah, they've varied a bit depending on how much was planted. I think Nick was showing the corn chart and how the drop in corn exports, largely because of not nearly as much production as we had anticipated because of the wet weather last year. So next slide, if you would. So this is how ag trade to China has gone, and not surprising, a lot of that growth in U.S. agricultural exports over time was also driven by increasing trade to China. And if you were to go back to the mid-2000s, China was a distant fifth in terms of our export destination. We were sending most stuff to Canada, Mexico, and then EU, Japan, and then China. But really by 2012-13, China was our #1 market, followed closely by Canada and Mexico. But you can see the trade has actually slipped over time. It's largely because in those first initial years down to 2016, it really was following the fact that soybean prices were falling over that period, and a lot as was corn prices and other things. Again, volumes very strong all over that period, but then in 2018 we had the beginnings of the trade war, and that really just slammed the door on exports to China. We saw essentially the world get replumbed in one sense, in that Brazil started emptying every bin it had to satisfy China's need for soybeans. And we started taking some of those markets that had been vacated by Brazil. So we had, the highest exports to the EU that we've had in many, many years. Egypt, there are a few other places like that where, we just had sent a little bit of soybeans in the past, all of a sudden sending more. And, it dropped all the way to 10 billion in 2019. And then, we've forecast now, and this is a fiscal number, forecasting for 2020, 14 billion. So still not nearly back where we were, but hopes because of the phase 1 agreement. Next slide. So, we had this announcement that China and U.S. had come to some agreement in the so-called phase 1 part of the agreement, where there was a little bit of stuff on intellectual property, but mainly it was all about agriculture. There are a couple of chapters in that agreement. It's a lengthy document, but a couple of chapters of interest. One is Chapter 3, which is trade in food and agricultural products. And I think this actually, there's some very positive things in this part of the agreement. It addresses the NTBs; those are non-tariff barriers, affecting a wide range of commodities. So you had dairy and infant formula, poultry, beef and pork products, pet food, other things that we were having a very, very difficult time getting into China because of SPS regulations, other sorts of things. This agreement is supposedly going to address those issues in the sense of China recognizing regulatory authorities within the U.S., and likewise with some of the imports that we do from China, I might add. But mainly for our purposes, looking at things that hopefully we'll see more poultry, beef, and pork being sold, pet food, other things, dairy products. Hopefully we'll see that start to emerge as a market for the U.S. And then the other thing is U.S. took at the tail end of the Obama administration, took 2 cases against China, one on domestic support, saying that China was over their commitments under the WTO in terms of providing support for wheat, corn, and rice producers. And similarly, when China joined the WTO back in early 2000s, 2001, they agreed that they would establish tariff rate quotas. These are commitments, quantity commitments. It says over a certain amount of imports, they come in essentially duty free, and then after that you have the over quota tariffs. And so, you know, they had established TRQs for wheat, corn, and rice. These were things that I think we sold to U.S. farmers as saying, hey, this is very significant access to a market that hopefully will grow over time. This was back in 2000. Unfortunately, China didn't do a very good job of filling those quotas, and I think it got to a point where a case was launched in the WTO. The U.S. argued before a panel that they weren't, that China wasn't in compliance. The panel agreed with them. And China agreed with just last year when the panel report came out. China agreed to comply. So both these rulings were sort of embedded in this document, and they promised to get compliance with these rulings. So we'll see. And then the other thing is, as many people know, we were doing a pretty hot business with China on corn a few years ago, and then all of a sudden that stopped with China saying, hey, you're shipping us corn that we haven't approved because of GMOs, and it's, you know, we can't import that until we've approved it. And so a lot of these negotiations have been ongoing for many years, including the NTB ones and the GMO ones. But this is finally put down in paper that they'll agree to comply with that. Again, these are all things that we hope to see, and but I think these are important parts of the agreement. Next page, if you would. And then the second part is, you know, kind of a unique part of an agreement. I mean, if I were to look at that chapter 3, that looks like a lot of agreements that the U.S. has struck with in bilaterals, or, you know, if you look at NAFTA, or if you look at TPP, or these typical things that are negotiated during those processes. Chapter 6 is a little different. It's a commitment by China to buy a bunch of agricultural products. And unlike, you know, most trade agreements I've been associated with, where typically what you have is either a reduction in tariff, or you have a commitment to have a tariff rate quota where you agree to bring in a certain quantity of goods. This is a volume commitment, and or a value commitment rather. And so as Nick had in his slide, it's around $12.5 billion above a 2017 baseline. In 2020, and then in 2021, $19.5 billion above the 2017 baseline. But in there it says, you know, purchases are going to be made at market prices based on commercial considerations and market conditions that may dictate the timing of purchases. So and I might add another thing that was put in, or that's in the agreement, is it says it won't do this at essentially by hurting another country that they've had made commitments to in terms of buying. So, you know, this just says that, look, this is going to be, we're going to buy that product because the, you know, prices are going to be right, and we're not going to buy products if, you know, the price is too high. Now that all gets interpreted at some level in terms of compliance, but I think it's instructive to have to know that there is language like that in the agreement. Okay, so next slide, if you would. So, you know, when this was first announced, I think the big questions I had, again, because this is a value commitment, not a volume commitment, you first get into, well, what is an agricultural product? And a lot of it became, what was difficult to understand is that the administration was talking about a baseline for 2017 of $24 billion. Well, if you look at the calendar year 2017, agricultural products are about $19.1 billion. If you add in the ag-related products, those are, you know, that does bring it up to 24 billion. But then when you looked at the agreement itself, things like forestry products, which are ag-related, they're not they're not counted as part of this. So it brings a lot of confusion. And then further on top of that, you get into the issue of, well, okay, is seafood included? Ethanol and distilled spirits look like they're included. So this brings it to 24 billion, but the whole question of valuation, if you're valuing it from leaving the US, that is FOB basis, it doesn't add up to 24 billion. However, what we've been told, at least by USTR and USDA, is that products are valued at the China, as they enter China. So obviously there's transportation costs that get added into that. For some commodities that may be as much as 10, 15%. So again, it's just not very transparent, and it's tough, to sit and say, okay, well, here's what we think is going to happen, because there's no fixed quantity, or it's all on value, and it doesn't give specific values for specific commodities. Now, what the agreement did say is that, or what administration officials have said is, yes, they know what those values are, but they didn't publicize them because they didn't want to roil markets. And I may get into that a little later on. I think what roils markets is uncertainty. And so I as an economist, I would have much preferred seeing what the actual commitments are. Okay, let's get into the next slide, if you would. So FAPRI did its best. When they put out their baseline, they realized that the baseline had been started pretty much before those of you who know the wonky world of baselines. Those things get started in the fall. And so before phase one was announced, FAPRI, like USDA, like the Congressional Budget Office, had been working on baseline, putting together their baseline for the next 10 years. And so what FAPRI did is they put out a baseline, but then they also put out several pages of analysis of what they thought the impact on exports to China would be. And again, based on what their read of this agreement, and assuming that there would be follow through on the agreement, that, these are big numbers for a lot of commodities. You see corn exports going to 4 million tons over the 2000. Effectively, there was almost nothing sold in 2017 for corn, but here these are all increases that are on the chart right now. And in soybeans, you actually look at you're adding 10 million tons to soybean exports, so quite substantial. Less so for wheat. Sorghum actually drops because sorghum, when the China stopped importing corn, they started importing a lot of sorghum and other feed grains. And so as corn comes back into the market, I think the feeling FAPRI analysts had is that you'd see a little less sorghum being done. And then the other big thing is, almost 6 million tons of DDG. So all of this very, very positive. Next slide, if you would. We'll show the livestock. And again, here, as I said, we were doing very little business with China. None in the base period, and all of a sudden, we're showing some big numbers. Not surprising on pork, I guess, because of the problems with African swine fever. China is not a huge beef consumer. If you look at in their diets, poultry and pork are much, much higher. But they're a big country, so getting any sort of beef into China is going to be a big deal. And obviously, a lot of that is hopefully moving in tandem with their relaxation on or acknowledgement that BSE-free beef and other things are from the U.S. are acceptable. So and then similarly with poultry. Okay, next slide. So the other thing FAPRI looks at, obviously, is they don't look just at what's going on with China. They want to know, well, how's that affecting overall soybean exports? So the interesting thing in the case of soybeans, so we had that huge increase in soybean exports. Now, the last slide was in tons. This is in bushels. So we're talking about an increase essentially going from roughly 500 million bushels to now about a billion bushels more under phase one, but coming pretty much at the expense of what we would be shipping to the rest of the world. And that's not too surprising. I mean, if you think about the trade war itself, what we saw is almost the reverse. That is, a lot of exports, 2/3 of our exports or so, going to China, all of a sudden dropping to almost nothing, most of that being made up of with trade going elsewhere. So a lot of diversion in trade, but remember that comes, China is a very strong market for us, and we expect, even with that change like that prices will be higher. So higher prices for soybeans as a result, largely because these are more profitable markets. To sell at a lot of the markets that we had been doing, we were able to make up those sales that we had lost to China last year, essentially by lowering our price, or soybean prices falling considerably. So even though this chart looks like, well, same old, actually these are at higher prices, so that's good news. Okay, next one, if you would, next slide. So then, I'll just wrap up what FAPRI says. They're expecting a $7 billion difference in net farm income because of phase one, and that continuing pretty much over 2022 as well, about $6 billion. So these are significant numbers. There's no question. Unfortunately, that all that analysis was done before COVID, and so let's turn to the next slide. And just looking at where we are right now, sales certainly have been lagging. China's already reported January through March number, and they're saying that ag imports from the U.S. were about $5 billion. Again, that's import value, CIF China. And so to kind of get those targets of under phase one, we're going to be needing to do about twice that every quarter over the next 3 quarters. I think those who answered that no, they didn't think we're going to meet those targets are probably right. And that certainly would be my suspicion as well. I think we'll be lucky to get the 2017 levels. But there are some encouraging signs, and we have made some sales of pork, cotton, wheat, corn, and sorghum, but it is a very, very slow pace. And the big one, obviously, is soybeans. And I think the press probably has made too much of the fact that we haven't made many soybean sales. Remember that soybeans really ship. China buys very strategically. They buy from the U.S. When our harvests are on and prices are low, and then as soon as crops start coming out of the southern hemisphere, they turn and shift and buy from southern hemisphere. So I don't think we'll see much sales or shipments certainly until late summer, early fall, and we are seeing little signs that I noticed some sales activity over the last few days, but again, I think the bulk of that's going to come towards the end of the summer. But to think that you can make up all of that, again, I get back to that first bullet point of really having to double that value. And remember, those are China numbers. It'll be interesting to compare their import numbers to our export numbers when our quarterly numbers come out in early May. Next, if you would. And again, here's the soybean sales commitments. They're running, no surprise, at least at this point, they're still running very, very much under previous year and way under where we were just back in 2017. So to make up all of that, we're going to have to start picking up that pace a lot over the next few weeks. And again, I just don't expect much until we start seeing the summer come on. Okay, so let's talk about COVID. Next slide, if you would. So, I know you've had a lot of people on over the last few podcasts talking about what the impacts are. So I'm not really going to go through them much in detail. You have the direct impacts so people actually developing cases of COVID that require sicknesses, and you've had to have shutdowns. Meat processing, of course, is a huge one right now. We've seen a little bit in farm labor, but again, for the most part, row crop agriculture, it's less of an issue just because you can do all the social distancing and all of that. But any place where you have a lot of people together, you got to be careful. And I guess meat processing, not only do you have people working very, very closely in under work conditions, but you also have many of those people sharing housing and other sorts of things. So a real problem. And then you have the impact of containment policies. And that, of course, is where we've seen the closures of non-essential businesses, the shelter-in-place policies, the big impact on ethanol now because of the fact that people aren't driving, and we're seeing huge decline in projected motor vehicle fuel use, and as a consequence, ethanol plants shutting. And then just a general disruption of supply chains. This whole issue of 50% of the food being consumed at home, 50% away from home, all of a sudden, most of that shifting to at home, and trying to move food now from places in food delivery services now into more of the grocery stores and things like that. It's very costly, and we're still see stockouts and empty shelves in grocery stores for a lot of things that you might have thought originally was hoarding, but now is just, I think, difficulties in getting these things supplied. I think all this will lead to some increase in retail prices. We're not seeing it right now, or at least not thus far, but I think if this continues, certainly will. But the bigger impact has been that the brunt of this has been borne by low producer prices. And you see so low that, and the fact that just physically you can't move a lot of these animals to slaughter. It's one thing to put beef cattle out on pasture to slow that. You can't do that with hogs. You can't do that with chickens. So you see all this depopulation efforts now being talked about. And then the bigger issues of containment policies are just the recessionary impacts. Next slide. I'm going to have to speed it up if we're going to get some questions in. Just to look at recession, think back to the 2008 recession. Here's what happened in global trade. If you look at 2009 levels versus 2008, ag didn't do nearly as badly as manufactured goods and fuel. We were down about 12.5% in value, and but only about 2% in volume. And compare that to these other sectors where you had far bigger cuts in volume. And most of the value drop in 2008 and 9, if you remember, was the fact we were coming off of very, very high prices. In 2007-8, we had a big global response, big wheat production coming out. And so that brought a lot of those prices down. Next slide. Next slide, if you would. Okay, so the IMF just came out with their forecast. They're looking at world GDP being down 3% in 2020. I think a lot of people think that's a conservative estimate in hindsight, that it may be steeper than that. But for what it's worth, they're looking at the U.S. being overall for the year down 6% in terms of GDP. And even countries, emerging markets, the countries like China, which for years were having double-digit increases in GDP, down only to 1%. Other big emerging markets like Brazil and Mexico actually being in recession. Some of that snapping back, and in this case, snapping back, with pretty good growth rates projected for 2021. But if we're looking at some other forecasts, next slide, if you would. The World Trade Organization, no, I'm sorry, if you can go back to that one. The World Trade Organization is also looking at, has looked at their estimates on GDP impacts. And there, I think, is a little more interesting. They talk about the various scenarios. So people talk about a V-shaped recession where it would essentially, if this whole containment policies, if you talk about people being at home for about 3 months, then the economy recovering, it would recover fairly quickly, at worst being only GDP loss of around 5% and rebounding by 2021. I think what people now think is far more likely is a U-shaped recession of 6 where the people are working at home, or at least the economy is very, very sluggish and dormant for about 6 months. And so overall impacts on the economy of global economy of being closer to 9%. And again, a big, when it does rebound, it rebounds very strong in 2021. But again, a very long time when essentially the world just isn't working and producing very much. And then the worst case is some L-shaped, where you have a big drop where people are stuck at home for 12 months. And, you don't hear too many people talking about that. All you hear, certainly some people talk about some aspects of the economy not being ready to get back for much longer than 6 months. So we'll see. But again, there being a very, very large impact. So I want you to keep these in mind as we look at some of the scenarios they have on world trade. Next slide, if you would. So here they look at what those scenarios would mean for agricultural products. Now, remember that I said that the 2008-9 recession had a drop of around 12%. That looks pretty much like that U-shaped recovery scenario, a little bit worse if you're under the L-shaped one. That is, even with a large recession, that agricultural products, trade in agricultural products wouldn't be affected nearly as much as manufactured goods. I mean, you see processed food products much like agricultural products. And the reason is because people have to eat, and they have to, so imports are expected to pretty much continue, although again, these would be drops in value. Next slide, if you would. Okay, so let me just wrap up, and I'll just do this really quickly because I don't have time to talk about these things in depth, but there's a lot of issues going on that I think, if it weren't for COVID, we probably would be talking about many of these today. But the one is we do have a NAFTA agreement that was renegotiated, supposed to go into effect July 1. There's a lot of people saying, could we put that implementation off, particularly in the automotive sector, where rules of origin and other things have changed, domestic content things have changed, and at a time when factories in Mexico and other places that are key for the car manufacturers in Detroit and elsewhere are having trouble meeting supplies. The White House thus far says, no, we're going forward on July 1, but there's been a lot of people asking them to put that off. We've talked a lot about China, implementation of phase 1. The other thing is that supposedly phase 2 was to take on, those negotiations were to take on the big issues that got us into the trade wars in the first place. That is some of the intellectual property issues, some of the business practice issues. I think a lot of people don't think that those negotiations are really going to happen before the election. So stay tuned. We didn't sign TPP. We pulled out of TPP. One of the big losses that for agriculture was the loss of the Japanese market because of that, and particularly because our competitors were all big competitors like Australia and New Zealand and others had access to that market, in Canada. We had a bilateral agreement on agriculture with Japan. That also is supposed to go into phase 2 negotiations. The important thing for US agriculture would be milk and our dairy products and rice were left out of those negotiations. They were part of TPP. I think both rice and dairy producers would like to get that back in and get some stuff there. We've had longstanding negotiations with the EU and US, and then also tied in with that is all the Brexit negotiations. I just don't see much happening before the end of the year on those with everything else going on. And lastly, let me just conclude with talking briefly about WTO. I mentioned these disputes we had with China that we won. Actually, we've won most of the disputes we've taken to the WTO, and I think that's been a very beneficial. This just says of the cases that went to panel, we won 80%. But remember that on top of that, there's another twice that many cases that were resolved prior to going to a panel. So all these things are very, very important. Lastly, I just want to talk, given the question that we had on export restrictions, the U.S. has been a very powerful voice in the world arguing against countries that have put on bans on exports. You remember back in 2007-8, 2010-11, we had countries like Russia and China and Ukraine and Argentina slapping on export bans on wheat. You had Vietnam putting export restrictions on rice, really contributing to a lot of the price spikes that we saw during those periods. We argued a lot against that, and I think that we've had a few signs. Russia, for example, has announced that will restrict exports to about 7 million tons through June. It actually doesn't look to be much of an issue. That's about what they export typically over the next couple of months in a typical year. So we don't think that's a binding announcement in any sense. But it's troubling to see countries bring those things up. But you can see by the poll itself that was taken, people are very sensitive to that. And if there are shortages, I mean, think if we change the question to PPEs, these protective devices like face masks and other things, I dare say we might see higher numbers there. People saying, yeah, we should have an export ban on those things. We ought to keep them all here in this country. But we have those sorts of challenges going on in the world. And I think it's really important to have my view is to have a World Trade Organization that's functioning and is able to at least address those issues. And I apologize for talking so long. Let me stop and take questions.
Hey, thank you so much. Joe Glauber, of course, is with IFPRI. I'm University of Illinois Extension's Todd
Yeah, show
Gleason.
that picture.
Nick Paulson is here as well. And there's Joe with his safety helmet on. I don't know whether, I'm assuming those all came from the night before, so he's probably safe when he's out during the daytime.
A little modified PPE there.
Yeah, yes, it is. Nick Paulson joining us, two ag economists from the University of Illinois. We'd like to thank, of course, our sponsors for the webinar series, including the TIAA Center for Farmland Research. That's here on campus up on the third floor of Mumford Hall at farmland.illinois.edu. Compeer Financial and Farm Credit Illinois, along with Growmark and the Illinois Corn Growers Association, and of course, the Department of Agricultural and Consumer Economics. A couple of things that are coming up for this webinar series include the impact of coronavirus on the livestock markets. That'll be next Friday, this coming Friday at 11 o'clock, May the 1st. And then on Tuesday, the 5th, we'll talk ag trade again, this time about how consumption patterns are shifting or may not be shifting. I haven't seen that just yet in China. So those should be a couple of good things. Be sure to join us at 11 o'clock on Tuesdays and Fridays for our continuing webinar series, Coronavirus and Ag. Let's ask a few questions. You finished up, Joe Glauber, with the WTO. What's your view of this as a trade dispute mechanism? And then what's its future and that of other global institutions, in your opinion?
Yeah, I think the WTO is facing a really serious challenge. I think just a quick recap. So one of the important parts of the WTO, it's a rules-based organization. So when countries don't obey the rules, what happens? Well, WTO isn't they don't have a police force. In fact, there's no real WTO per se. What the WTO is the collection of all the member countries. And so what members are able to do is they're able to, if they think a country's not playing by the rules that everyone's agreed to, they can take a case against them where they are essentially a panel looks at that's been appointed by the members, looks at the evidence, makes a ruling, and then there's an appeal process that is also with appellate board members approved by the WTO members. The U.S. has been blocking appointments to that, and you need 3 people to compose a panel. Essentially, typically there are 7 panel members, and they rotate on which panels they're on. But back in December, we got down to just 3. 2 of them, their terms were ending. The WTO membership had put forward 2 more names, but the U.S. decided to block, as they had for a number of years. And as a consequence, there is no appellate body right now. There's not a functioning appellate Many countries, including a lot of our allies like Australia and Canada and others, have informally agreed to abide by WTO decisions that they will. They've kind of set up a shadow appellate process, but it's unclear, and I think that's going to be a big debate. It's hard to see how the dispute process can continue if there's no appeal. And again, as I would say, I think the U.S. has done very well. Agriculture has certainly done very well by this, and I would argue that for the overall economy, other sectors as well. But big challenges to get that resolved, because I mean, people talk about it as being the crown jewel of the WTO, and it is the one thing that has functioned probably the best of all. I mean, we haven't made much progress in negotiations, limited progress, I guess, since the original Uruguay round agreement was settled. But I think dispute settlement is something that has been very successful.
We have about 5.5 minutes before the top of the hour. Is there any expectation China will purchase U.S. ethanol? If not, why?
Yeah. Well, I certainly think there's expectations, or there certainly were expectations that China would purchase ethanol. I think the couple things that I would note is that China had been on has a renewable fuel program, but I think this was back in December or maybe early January, talked about, or there was an announcement out of China is that they were going to relax the blending constraint, which made me think at the time, well, gee, does this mean they don't need to import as much ethanol as we might have hoped? But I think bigger problems now are the fact that you just have, I mean, the U.S. isn't the only country where people are driving a lot less, and the fact that oil prices are down as low as they are. Hopefully we'll see these markets start to rebound as the recovery comes in. But whether or not we see much ethanol being purchased this year, we might see some symbolically, China making some purchases for that. But I think whether or not it is over time, I think that's a different story. We could see some markets develop, and I think that's the hopeful thing about this agreement is that we will see, once all this COVID disruptions are over with, that we'll see more trade start flowing.
I'll follow that up with some more ethanol, but trade issues, and both domestically or on the international front, and then supply management as well. How fast can ethanol production come back in the United States? I think that's also related to the RFS and 2022. And then how do you go through this big pile of corn that's building up? And that comes to a supply management question that people are asking.
Yeah, I think insofar as ethanol production is concerned, I think that really is going to be dependent on domestic, that is U.S. Motor vehicle use, and I think it would be hard to start driving that off of foreign markets. That again, I think there's just the similar economics that we see here are also going on in foreign markets as well. How fast they can come on, I think that's there are probably people that have far more expertise in answering that question. But I would imagine that if we start anticipating demand coming back on the more motor vehicle use and start seeing projected gasoline consumption back in the 130 billion gallon range, that we'd start and above, that we'd start with those things would come on as quickly as they could. The corn's there, obviously, and that is a bigger issue right now, right? It's just that we have bins full of corn, and farmers trying to make planning decisions where, certainly what the intentions report suggested, 97 million acres. certainly the soybean corn ratio has changed a lot since then. It's now up to 5 or higher, pointing to more beans. We'll see. I think supply management is a mistake because I think that only gives markets to other countries. But I do think that also means that in some areas of the country they may not be growing as much, putting in as many acres of beans and corn as they might have otherwise. I mean, you talked Illinois. These are this part of the Midwest is where our comparative advantage is. I mean, we're low cost producers worldwide. I don't expect much drop off there, but I think in some of the other areas where we've seen expansion of being in corn area, if you have continued low prices, I think you will see some changes there. The problem is there's no great alternative, right? I mean, this isn't like you're going to turn to some niche crop or even traditional crops in some of those areas like wheat. I don't see it. But I think we're any hopes to pull out of the kind of the levels of stocks and other sorts of things that we've seen, short of a major drought somewhere. I think we're going to be looking at big stocks coming out of this crop here.
We're at the top of the hour. We only have 3 questions left, so I think we'll try to get those in. For those who need to leave, go ahead. Otherwise, we'll stay with this for just a second. Do you anticipate any long-term impacts of U.S. support for managed trade with China?
Yeah, that's an interesting question, and I think that's the thing that bothers me most about this agreement. What the agreement says is that after 2021, we expect over the next 4 years or 3 years afterwards that trade will continue on that trend. But the problem I have is that because you're not doing anything structural, you're not reducing tariffs. I mean, if you had said, okay, we're going to take soybean tariffs down to 0, well, that gives us an advantage against Brazil. And that would be certainly something where, I mean, tariffs are low already. I mean, they're at 3% without the additional tariffs. But if you were to talk about reducing corn tariffs down to 0, the over quota tariffs on corn or wheat, then I think, okay, those are things where you can really see where China would really start to import. In my view, what you want are the commercials making those decisions, right? I mean, you want private companies to say, we're going to bring this in. You don't want COFCO to be the one who's making sure that the trade agreement holds, because I think unfortunately when it gets down to that, then you're really talking about an agreement that can be broken as soon as the government says, well, yeah, that was then, we're going to look at something different. If you think about, some of you out there are probably old enough to remember long-term grain agreements that the U.S. had with Russia or the former Soviet Union and even China. I mean, they look great on paper, but they always fell apart. And they fell apart within, a year or so a couple of years of them making these long-term arrangements, that things happened and people just said, oh, well, we can't do that. Sometimes that was bonehead moves on our part, embargoes and things like that. But it's just to say I would much rather see substantive reforms on trade barriers and lower those. Then you'll have trade, and I think that's been the experience. So sorry, I'm going way too long. Let's take your next one.
So one final question then, and it's related to what you just discussed. What is the political calculus in Washington, D.C. as it relates to coronavirus in China and trade going forward? Meaning, what will Washington do?
Hard to say. I mean, it just, again, getting back to our earlier point I made, we kind of shift our focus from one big crisis to the next crisis without much thought in mind. It's almost like phase 1. What was in phase 1? I got to remember. And I think everyone hopes that there will, certainly on the ag side, we hope that there will be a normalization. I'd be perfectly happy to see us back to, pumping out like the volumes that we were seeing in 2017 with growth because of increased demand for protein and other things in China. But what's just so hard to see is how, is this COVID-19 a temporary phenomena? In which case, do we see the recovery and then everyone kind of remembers it like, oh, gee, that was a bad year? Or is this some new normal? And I hope it's not that, but there's still just so much uncertainty there.
And finally, we talked about this before we started, and the question I wanted to have you answered, because I think it informs probably much of your thought process over what we've discussed so far. What's your definition of food security?
Well, I think it's a pretty minimalist definition. I think you typically look at having adequate number of calories for the member or people in the population. So in some areas there is malnutrition where there's not enough. It's very rare that there are actual famines. I think what you typically see are political issues that keep calories from flowing from one part of the country or one part of the world to another part of the world. I think trade's a really important factor there. That certainly, if you look over the last 10, 15 years, the role of imports in terms of meeting consumption has grown around the world, and particularly in the really big net importing countries like North Africa and Mideast or other areas. And I think trade barriers are the things that when you talk about food security, they're a really important part of that they really need to be addressed, not just trade restrictions, which we touched on briefly, but also lowering tariffs and other things to allow product to move to those people who need it.
Joe Glauber, thank you so much for joining us today.
Yeah, no, thanks. This was great.
Nick Paulson, thank you for being on hand with us as well too.
Mm-hmm.
Nick Paulson,
Easy
of
job for me.
course. Indeed, Nick Paulson, of course, is with the FarmDoc Daily team, part of the University of Illinois here on the campus in Urbana-Champaign. Joe Glauber is with IFPRI, the International Food Policy Research Institute out of Washington, D.C. Thank you so much for joining us, and thanks to Jim Baltz, who's been the technical director behind the scenes for the day. You have a good week. I'm Illinois Extension's Todd Gleason.